Let's talk about where are we going to be for the end of this year and probably more importantly, towards the end of 2025. So let's go ahead and get started. Trump won. What does that mean for the markets? Well, if you recall over the last few months, and you've probably seen it in other places, where the chart for the stock market, regardless of whether there was a Republican or a Democrat in office, continually moves up. Now, what determines whether it goes down? Generally, that's a recession. And you can see on this chart, you've got the blue line, which is the earnings per share, the EPS, which again is looking very positive right now. And then you've got the correlating red line, which is the S&P 500. And you can see over time, it just makes this nice ski slope up. And we're anticipating that moving forward in 2025. Okay, let's talk about the S&P 500 and earnings, because again, earnings is what's going to drive the market. And as you can see on this chart, it goes back to 2019 all the way up to the estimates in 2025. And the way you want to read this thing is really the blue are years that are already in the records. And you can see even from 2019 through 2023, with possibly the exception of 2020, which again, everybody knows we shut down the country at that point. We would have expected the earnings to be low at that stage, but they bounced right back in 2021. 2022 was good. 2023 was even better. And they're forecasting for 2024 to be even better. And to put the icing on the cake, the forecast for 2025 is even better than 2024. So the earnings are definitely going in the right directions. And again, like the statistics that you saw relative to the year following the presidential election, you're seeing that earnings are also showing that same sign of increase. And like I said, earnings is what drives the market. When a company is very, very productive and they end up with good earnings, with sales, it drives the stock market forward in a specific company. So this, again, is a very positive sign. As you can see, with the new administration, the regulatory environment will likely ease, particularly with regards to energy, financials, and labor policies. Again, bodes well for the stock market. And when you think about the tariffs, Trump is going to put more tariffs in place, but you really have to look back in history. He didn't do it in such a way that created A, inflation, and B, ruin the economy. In fact, it actually did the opposite. And, things got better under the tariffs that were put into place. So you can expect them to be putting a measured response relative to tariffs. And then lastly, now that the election is behind us, we believe the markets will return to focusing on fundamentals such as corporate earnings, interest rates, and the economy. And again, that's what we should be focusing on, because it's the numbers, it's the stats that we get that literally are going to decide whether we're going to propel forward or fall back. And right now, the signs are really looking positive for us. Here's where we are year to date based on these three different index performances. And you've heard us talk about the S&P 500 capital weighted and equal weighted. The capital weighted, again, is pushing forward year to date. 26+%, and since the election, it's up 4.8. You look at the equal weighted, not up as much. Why? Because again, it's driven by the broader market, not a handful of tech stocks, which is actually still pushing the S&P 500 capital weight way ahead of the broader market. But even looking at this year to date, we're at 4.4% on the equal weighted. Now, where are we having problems right now? Well, it's the bond funds. The U.S. Aggregate Bond Fund, AGG, is effectively year-to-date down almost 1%, and since the election, down about 0.3. So we've said this before, we are in a secular bear market for bonds. At the beginning of the year, we were down. Halfway through the year, we were up about 4%. Now we're down again. And it's just going to be that sideways market for bonds moving forward, until something major changes. And we're not really looking at that happening for another 5 years or so. So it is important to understand how bonds are going to affect the overall portfolios when you're looking at more conservative investors. One of the reasons we've been using the money market accounts, because at least there, we're going to get between 4 and 5% within that account for those clients. That's not a bad rate of return when you think about the alternative with bonds, which just are not performing.